Imagine paying someone thousands of dollars a year and hoping you never get anything back. That's insurance. You hand over your money. You pray nothing bad happens. And if nothing does, they keep every cent. But here's where it gets wild. The global insurance industry pulls in over $8 trillion a year. That's bigger than the entire GDP of Japan, Germany, and the UK combined. So what are they doing with all that cash? And why does Warren Buffett call insurance the most important business he's ever owned? Today we're breaking down how insurance really makes money, from a hidden trick called the float that gives Buffett $174 billion of free money, to why your premiums have almost nothing to do with fairness, to the massive disruption that could change everything. Stick around. The real business model is not what you think. Here's what most people think insurance is. You pay a monthly bill. If something bad happens, they pay you back. Simple, right? But there are nearly 6,000 insurance companies in the United States alone. They collected $1.7 trillion in premiums last year. That's roughly equal to the entire GDP of Canada. The average American family spends about $24,000 a year on insurance. Health, auto, home, life. That's more than most people spend on food, more than transportation, sometimes more than their mortgage. So here's the question nobody asks. If insurance companies pay out claims all day long, if hurricanes cost them $140 billion in a single year, how are they not just breaking even? How are they the most profitable businesses on the planet? That's not a business. That's an economy. By the end of this video, you'll understand how insurance companies turn your fear into their fortune. We'll go back 5,000 years to where it all started. We'll crack open the business model that made Warren Buffett the richest man in the world. And we'll look at the technology that's about to flip this entire industry upside down. Insurance is older than written language. 5,000 years ago, Chinese merchants faced a problem. They had to ship goods down treacherous river rapids. One capsized boat meant total ruin. So they came up with something clever. Instead of loading everything onto one vessel, they spread their goods across dozens of boats. If one sank, every merchant lost a little, but nobody lost everything. That idea, spreading risk among many, is still the foundation of every insurance policy on Earth. But modern insurance? That started with fire. It's 1666. London. A small bakery on Pudding Lane catches fire. Over 4 days, the blaze devours 13,200 homes and 87 churches. An entire city gone. And almost nobody had any way to recover their losses. Within years, the first fire insurance companies appeared. Then in 1688, a man named Edward Lloyd opened a coffee house on Tower Street. Sailors, merchants, and ship owners gathered there to buy and sell maritime insurance over cups of coffee. That coffee house still exists today. It's called Lloyd's of London, and it insures $40 billion in premiums every year. In 1752, Benjamin Franklin co-founded America's first insurance company, the Philadelphia Contribution Ship. It offered fire insurance to Philadelphia's 15,000 residents. That company is still operating today, over 270 years later. But the real revolution came in 1929. The Great Depression had crushed hospital revenues. Baylor University Hospital in Dallas saw their receipts drop from $236 to just $59 per patient. So a man named Justin Ford Kimball made 1,300 school teachers an offer. Pay 50 cents a month. Get up to 21 days of hospital care. They called it Blue Cross. And it became the blueprint for modern health insurance. From Chinese river merchants to Dallas school teachers, the core idea never changed. Pool money from many. Pay out to the few who need it. But what the industry did next with all that pooled money, that's where it gets interesting. Most people think insurance companies make money the obvious way. You pay premiums. They invest a little. When you file a claim, they pay out less than they collected. The difference is profit. And that is part of it. It's called underwriting profit. Insurance companies track something called the combined ratio. If they collect $1 in premiums and spend 96 cents on claims and expenses, the combined ratio is 96%. They keep 4 cents. 4 cents on every dollar. That's the official profit margin. But here's what most people don't realize. The real money isn't in the 4 cents. It's in the timing. Think about it. You pay your premium in January. But your claim? That might not happen until July. Or next year. Or never. So what happens to your money in between? The insurance company invests it. Stocks, bonds, real estate. They're sitting on your cash, earning returns for months or years before they ever have to pay a claim. This pool of money, premiums collected but not yet paid out, is called the float. And it's the greatest financial trick in modern business. Warren Buffett understood this better than anyone. In 1967, he bought National Indemnity for $8.6 million. Today, Berkshire Hathaway's insurance float sits at $174 billion. That's $174 billion of other people's money that Buffett gets to invest for free. And here's the kicker. In 2024, Berkshire didn't just invest the float. They earned $11.4 billion in underwriting profit on top of it. They got paid to hold other people's money. But here's the second aha moment. Insurance companies don't just bet on you individually. They bet on math. They employ thousands of actuaries, mathematicians who calculate the exact probability that you'll file a claim. Your age, your zip code, your driving record, your credit score, it all goes into a formula. And that formula is so precise that the workers' compensation line ran a combined ratio of just 88.8% in 2024. For every dollar collected, they kept over 11 cents before investment income. Think about that for a second. They collect your money. They invest it for free. They use math to make sure they almost never lose. And even when catastrophe strikes, $140 billion in natural disaster losses in 2024, the industry still turned a profit. So the business model is 3 layers deep. Layer 1, underwriting profit. Keep a few cents on every dollar. Layer 2, investment income. Earn returns on the float. Layer 3, actuarial science. Use math to guarantee the odds are always in your favor. Insurance isn't gambling. It's the house. So who dominates this $8 trillion industry? The answer depends on where you look. In the US, one company towers above the rest. United Health Group, $324 billion in revenue, 152 million customers. They've been number one for 11 consecutive years. Their market cap hit $557 billion, making them worth more than most countries' entire stock markets. But globally, China's Ping An Insurance holds $1.5 trillion in assets and serves 227 million customers. Germany's Allianz manages over $1 trillion in non-banking assets. France's AXA covers 94 million people across the world. But here's what makes this industry unique. The biggest winner isn't even an insurance company. It's Berkshire Hathaway, an investment company that happens to own insurance businesses. Buffett didn't buy insurance companies to sell insurance. He bought them to get the float. State Farm, the largest property and casualty insurer in America, is a mutual company. That means it's owned by its policyholders, not shareholders. They wrote $103 billion in premiums last year. And Progressive? They surged 20% in 2024 to become the world's 4th largest property and casualty insurer. But the giants should be nervous. Because the disruptors are coming. Lemonade, Root, Hippo. These insurtech startups use AI to process claims in seconds instead of weeks. Lemonade hit $526 million in revenue in 2024, up 29%. Root stock surged 240%. Hippo achieved positive net income for the first time. None of them are consistently profitable yet, but they're growing fast. And they're proving that the old guard's biggest advantage, complexity, might be their biggest vulnerability. The insurance industry is about to change more in the next 10 years than it has in the last 100. Here's why. First, usage-based insurance. Right now, a $62 billion market. By 2033, it's projected to hit $355 billion. Your car already tracks how you drive. Soon, your premium won't be based on your age or zip code. It'll be based on your actual behavior. Drive safely, you pay less. Drive recklessly, you pay more. Every single trip. Second, parametric insurance. This is the big one. Instead of filing a claim and waiting weeks for an adjuster, parametric insurance pays out automatically when a trigger event occurs. Earthquake above magnitude 7. Money hits your account the next day. No paperwork. No adjusters. No arguing. The claims process, the thing everyone hates about insurance, could disappear entirely. This market is projected to hit $34 billion by 2032. And then there's the elephant in the room: climate change. In 2024 alone, natural catastrophes caused $320 billion in total economic losses. Only $140 billion was insured. That $180 billion gap? That's the biggest opportunity and the biggest threat the industry has ever faced. AI is already transforming claims processing. It's cutting processing times by 65%, reducing fraud losses by up to $44 billion a year. And embedded insurance, policies sold at the point of purchase, is a $119 billion market heading toward $800 billion by 2032. The future of insurance isn't about selling you a policy. It's about disappearing into the background of every transaction you make, invisible, automatic, and everywhere. So the next time you open that insurance bill and wonder where all your money goes, now you know. It goes into a float. It gets invested. And the math is designed so the house almost never loses. Insurance companies don't sell protection. They sell the promise of protection and profit from the waiting. Remember what we said at the start? You pay thousands every year hoping you never get anything back. Now you know exactly why that model made Warren Buffett one of the richest people on earth. From Chinese merchants spreading cargo across boats to AI that processes your claim in seconds, the core idea hasn't changed in 5,000 years. Spread the risk. Keep the float. Do the math. If this changed how you see insurance, you'll love my breakdown of how the banking industry really works. Links on screen. Subscribe for more industry breakdowns every week. I'll see you in the next one.